Hi traders, Roberto here, and here's another tutorial for the Pro Traders Workshop series, and we are continuing to go over the divergence strategies. And in this video I'm putting it on YouTube to give everyone a chance. Those of you who have not signed up for the Pro Traders Workshop, there's still time to get in on the reduced rate at $79 a month, and you receive all the trade signals, daily trade signals, plus the workshop videos. And I normally do 2 a week, and this is the second video, and we are continuing the divergence setup strategies on daily charts. So I'm always looking for divergence on daily, because when you see these setups, it could be a substantial reversal. And you can manage this trade by staying in, by lowering your stop losses, for example, on this trade. And let me just show you this is a very classic traditional divergence, negative divergence setup on this particular pair, is a Canadian Swiss. And of course we're looking for that wave pattern, and here's one wave, and here is the second wave, and the second wave is lower. Let me just remove that. The second wave is lower than the first wave, and price is going higher where the wave patterns are going lower, hence we have divergence. Now on price, I'm always looking for this 1, 2, 3 pattern. It's an Elliott wave pattern, and then I'm waiting for price to break the swing point, which is here. Once that swing point is broken, then this divergence setup is confirmed. And the next thing I do is take my Fibonacci tool, and I draw from the swing high all the way to that swing low. This is very specific, very high probability trade setup based on very specific entries, waiting for divergence to complete. And for that to happen, this swing point here needs to be broken. It was broken, and price was oversold at the time price came back down to this level. Retraces to where? Anywhere from 50 to 61% retracement level. That would be our entry. Our stop loss would be about 20 pips above that 61% retracement level. I would normally put a stop loss above the swing high. That's just in case market does retrace close to the 100% retracement level. This is the first stop loss. If price, normally it rarely will break the 61% retracement level. And look at this rundown. Okay, so this is a very classic divergence setup on a daily chart. Notice price, we had 1, 2, 3 pattern. You connect the swing patterns, line them up with the swing points. Okay, so this is a swing point, this is a swing point. They match up with the wave patterns, but the wave patterns are going in the opposite direction as price action. You wait for price to break the swing low, which is this B. I have one A, B, and C, which is Elliott wave. So wait for the B, that swing point, to be breached, wait for a retracement, and this is a daily chart. We're looking at several days, possibly 2 weeks before you even enter a trade. Or you can enter a trade, but you have to make sure your stop loss is above that swing high. Okay. So the entry is up here at this level, 50 to 61%, and our stop loss is above C, or above the 61% retracement level. And you would stay in this trade as long as you can. Notice price retraced, sold off, retraced, sold off, and we have lower lows and lower highs, and the market continue. This was back in August 2012, and look at this trade. If you could have managed this trade, stayed in from August all the way to June of 2000, for almost a whole year. Okay, now one of the reasons I wanted to show you this is because we see, let me just show you another trade setup. Okay, before I show you what I wanted to show you. Here's another one, February 2014. Again, we have wave patterns that, now this is a divergence, a positive divergence going in the opposite direction as the one that I just showed you. And we have swing points that are going lower. So we have divergence. Wave patterns, this wave pattern is lower than this wave pattern. This swing point is higher than this swing point. So we have divergence. So market finally breaks the most recent swing high, which was here. And that's what we're looking. We're looking for a swing point. It did not break this swing point. We didn't need that swing point to be broken. All we needed is any swing point on the daily chart, and it was broken. So once that swing point is broken, I wait for the market to retrace, and I know that, okay, I have a swing point here, so I need to draw my Fibonacci. I need to take my Fibonacci tool, let me just remove it, and draw it from this swing low to that swing high, and price came back down to 50%. That would be our entry with a stop loss below the swing low here. And notice that price has kept going up. Okay, May, June, July, August. Now, I wanted to show you those two examples because, look, I wanted to show you what's happening right now. Same thing. We have, this is the most recent trade signal that was sent out today. So those of you who are in the program should have received this signal. Okay, so we have wave patterns that are going in the opposite direction as price. Remember that if you don't have these swing points lining up with the wave patterns, you don't have divergence. Okay, so here's a wave pattern, here's a swing point, here's a swing point. Swing points are higher and the wave patterns are lower. Okay, so as long as price is inside these waves, then we have divergence. What happens? Remember we have that 1, 2, 3 pattern. Price breaks below the swing point and then retraces to 61%. That's our entry, and we are currently short on this pair. Our stop loss is above that 83, 86.30 area. I might have put a lower stop loss. I think I put a stop loss above that 61%. So that's the trade that we're currently in. Okay, and that's it. That's how you qualify a divergence setup on a daily chart. Now, is this going to continue to go down 2 or 3 months? We don't know. We do know that on a daily chart, we should be able to make at least 100 pips on these daily setups. And certainly that was the case on this one. Price came back down, and look at this trade. It went up 639 pips. So we should at least make 100 to 200 pips on this trade. Okay, we have an entry, and we're looking for price possibly to go down all the way down to these levels, and that would be, because that's a very strong support. And that would be, how many pips would that be? 84, 90, from 85 all the way to 78. I have a target of, first target is right at 84. If it breaks that, I'm just going to take a small position out and stay in, maybe take half a position out, because that's the next stop loss is around this level of support. Actually, it's 83.46. Good. We have another divergence set up on pound dollar. And with this one, I was using stochastics indicator. And let me just try to, here we go. Let me pull up also MACD so we can use both. Okay. So again, wave patterns, we connect the wave patterns. Here's a swing point, here's a swing point. From swing point to swing point, price is heading south. I'm sorry, I used the wrong wave pattern. Here we go. Swing point to swing point, and then here's the wave patterns are going up. Again, this wave pattern is lower than this wave pattern, and it matches up with the swing points on price that are going in the opposite direction. Price broke a swing point and then came back down. So we take our Fibonacci tool and draw it from the swing low to the swing high. Price came down to 50%, and 50% is a very common Fibonacci area for the pound dollar to react to. I don't know why, but I've seen this over 1,000 times. Whenever I take my Fibonacci tool and I try to find the retracements, for some reason it always falls at 50%. And in this time it did just that. 50%, that's our entry. The stop loss is below the swing low. And let's look at this on the stochastics indicator. Stochastics indicator, I drew this one. Here's a swing, here's a wave pattern, a whiff pattern on stochastics, matches up with this particular swing point. So oftentimes it doesn't matter which swing point you use, as long as the wave patterns match up and go in the opposite direction. Remember that stochastics and MACD are a copycat of price. Price goes up, stochastic goes up, MACD goes up, but when they go in the opposite direction, then we have divergence, and that is signaling a change in sentiment, a change in direction, and that's exactly what's happening with the pound dollar right now. So that's it for this tutorial. Please sign up for our, I have this here, our Pro Traders Workshop Series. I think I've lost it. I don't know what I did with that website, but let me put it up. It's just log on to fx-northwest.com. We offer a variety of products, private coaching sessions, which includes everything, trade signals. We have trade copier. If you don't have time to trade and you just want for your trades to be executed automatically, we offer that. And we also have trade signals, which is our very good offer, $79 a month, which you can cancel at any time. You get trade signals, you get tutorials like the one you just watched, and you can contact me anytime, any questions you may have on trading. Have a good trading week, and thanks for watching this video.